Y'all, so my student loans nearly took me out of the home buying process. But I persevered. And I'm going to talk about 3 financial areas that you want to be aware of and prepared for, and how they directly impact your home buying process. So if you are new here, hey, my name is Jocelyn, and I am the founder of Real Estate Prep, which is a community for first-time home buyers that are looking for the tools, tactics, and resources that they need to confidently make the biggest purchase of their lives, and that is usually their first homes. So I humanize the process for first-time home buyers that, other people aren't. And I give you my honesty as a non-agent, even though I might be one later, as a non-lender, non-association to real estate. I'm just giving you my honest experience of what I learned, what I succeeded at, and what I failed at. So if you happen to listen to some of my other podcasts or follow me on Instagram, that I had a lot of debt, student loan debt, which is the number one area, or one area of many financial areas that we'll discuss today that is important to lenders. So your debt can be car, it can be student loans, it can be clothing, you name it. For me, it was student loans. I had a lot of student loans. I went to a private institution. So when it was time for me to buy my first home, my debt to income ratio was very, very high. And industry wise, lenders like to see less than 36% as your debt to income ratio, which is your debt versus your income. And they calculate a percentage based on what's going out and what's coming in, to help them determine what is feasible to loan to you, essentially. So that plays a big part. And for me, my student loans was my main source of debt. And it boosted my score very much, because what I had coming in was great, but what I had coming out was just as high, and it just presented me as a high risk, borrower. And that just didn't help me during my first kind of go around with home buying. So that was one area that I spent a lot of time improving. The second area, make sure you improve it, calculate your debt to income ratio. There's tons of calculators out there. I'll probably link one in the description box so you can understand where you stand. And again, the goal is to stay under 36%. Some lenders even have lower thresholds. So you just need to understand who you're working with and what they want to see so that you can get yourself together financially. The second area is your savings. So you're going to need money to close on this home, even if it's 3%, 3.5%, that's just the down payment alone, which is a portion of the price of the home that you'll be paying to basically guarantee, like, here's a little bit, now give me the house, essentially. But there's other fees, there is an earnest money deposit usually, which is another deposit that you'll have to pay when you sign the contract, especially if it's a new build, like basically to lock in, like, I want this. And I know it's going to take a couple of months to close. If it's a new build, if it's an existing home, it might take a month to close, maybe 2 months to close. But this is your sign of good faith that you want to give to. Most lenders require, not even give, because it ain't a gift. They require it, and they'll put it in an escrow account, and it can go towards the ultimate purchase when you're at your closing. But that's another thing you want to consider. When I was first doing my, when I was on my journey a couple of years ago, like it was, I want to say, was it 1,000? I think it was 1,000, and then it was 1,000 for this one as well. So 3.5% of the total purchase home plus your earnest money plus your closing costs, which are usually like your appraisal that you might have to pay for. Excuse me, there's title fees. There's just so much. Like, I'm gonna have to do a video on that as well. Underwriting fees, if you want to have discount points for your loans, like there's just so much. I'm definitely gonna do a video on this. I'm gonna do a video on that. But that is all stuff that you'll need to close. And then stuff that people don't even think about, such as moving, furniture, turning your utilities on, like internet, simple stuff like that you don't think about. Like, you want to have money to get all that stuff going. Like $5,000 is just not going to be enough. So like, you want to be realistic with like how much you can actually save Usually people say, $10,000 to $20,000. Do what's best for you. Just know 5,000 ain't enough. I would say at least 10,000. Like, and again, I'm not no financial advisor or none of that. I had more because I knew I wanted to get in this thing and deck it out, and I don't want to have to be robbing Peter to pay Paul. Like, I just didn't want to end up in that situation. So have a good amount. Like, honestly, I will say 20,000, but I know that's not realistic for most people. And it depends on how much the purchase of your house is. But it's a good rule of thumb to have a good 3 to 5% for your closing and 3 to 5% for your down payment, at a minimum, and again, all those other fees that we haven't even discussed that relate to you just getting in here and being comfortable. The last thing that matters is your credit. So if you have other existing lines of credit out there, that's not a bad thing. You do want to have established credit. That's a good sign to lenders, but too much is not a good sign, So if you have something that's open for a long time and you're paying it consistently, it's up to date, that's a good thing. But if you have stuff in collections and all this other stuff that, you aren't proud of, that can hurt you in the long run. So, just pay attention to like what's on your line of credit. And what I would recommend, or what's on your credit report, is actually pulling your credit report. So usually on like annualcreditreport.com or something like that, I'll put that in the description as well. Usually you can pull it for free annually, which means once a year, so you can understand what's there. But if you know that, you pulled it this year and that was back in February and it's now, who knows, like November, and you want to close it for the end of the year and you want to see what's going on your report, like I would be willing to pay. If I was in your shoes and it was something like that, I would be willing to pay just so I can understand what's on there, because you don't want to go through this whole process and get a super high interest rate because you had stuff on your credit report that you weren't aware of. So that's just my recommendation. Again, this is not financial advice. This is just based on my experience and the things that I've done. But yeah, make sure that those areas are in good shape, because the better shape they're in, the better interest rate you'll get. The lower your debt to income ratio is, and the more options you have to find homes, because you'll be approved for more, you'll have a lower debt to income ratio, and you'll get a really good interest rate, which means that the interest that you're paying is low. The goal is to get it as low as possible. Like, we talking 2s and 3s, but realistically, some people it's 4 and 5. But like, if you do the work to get your finances together, like you can get a solid 3%. I mean, it's top of 2022. Things could change. It can go up, it can go down. But right now, if you have your stuff together, like, and you're ready to buy, like, and the financial blueprint looks good, like you can definitely get it, a 3%. But again, this is just based on my experience and what I'm seeing in the market. You have to study your market. But I hope that this was helpful. So again, the 3 areas that directly impact how much you can borrow, which means how much you can purchase for a home, is your debt, student loans, car, all of that. Your savings, which is what you'll need for your down payment, your closing, and all the other associated fees with getting out of your existing residence into your new one. And then your credit, which is your credit report. They want to know how many lines of credit you have. Are you paying on this stuff on time? Is there anything like not in a good situation, like delinquencies, bankruptcy, all of that, because all of that matters, but only for a certain amount of time. So I'll probably dive into this a lot more, because there are so many fees associated with closing that deserves its own video. But again, if you have any questions, or if you want me to cover anything else, please comment down below. Let me know your thoughts, let me know your questions, and I will do my best to answer them on a future video. And if I don't have the answer, like I said, I will refer you out to someone that does. So thank you for watching, and I will see you on the next video.